Over the pandemic, that trend accelerated because a lot of people were hanging on and staying in the labor force, right? Because they didn't have enough money to retire. Pandemic came along and a lot of people just left the labor force. So what does it mean? So there's a lot of talk of inflation and growth, but the trend rate of growth is likely to be going down because, and we won't know for a year or two until the stimulus comes out and the economy settles. But the reality is the highest earners have now stopped earning and they've left the labor force. So now left with their savings, a lot of them will switch to bonds. And so they've got their final amount of money, or they become more risk averse because God forbid you get a 50% market crash and lose half your wealth on retirement. So therefore, what's weird is also people are living longer. Well, actually not in America, bizarrely enough, but everywhere else in the world, people are living longer. So they're trying to calculate this pool of money, is it enough? So I'm seeing my mother going through this calculation right now. She's 78 years old. And she doesn't know if it's going to be enough. Now, luckily, I can backstop her. But others don't know that equation. And the fear is, imagine being 80 and running out of money and living for another 7 years. That's the terror of imagine if I become destitute. So what it creates is a behavior that people tend to spend a lot less than they would have done. So I think that the baby boomers en masse will spend less than they would have done. So we'll wait and see how it plays out, but that's my best guess. When you look at the labor force participation rate, which is basically the same thing, and it's all in that video, and I showed in that video too, that the Fed balance sheet follows it. And I can project forward, because it's demographics, the labor force participation rate, and it shows that the Fed balance sheet keeps going, because they're trying to fill the growth gap as these people come out of the economy, because you've got this big problem of debt, not enough growth to service that debt equals Federal Reserve plus taxes. It's a complicated soup that just generally means, and we've seen it in Japan, that trend rate of growth is lower than we ever imagined. I said, we need to speak the language of Barra, which is a portfolio asset allocation tool. So oddly enough, a Real Vision member said, oh, by the way, I used to work for Barra, and then I worked for the other competitor to Barra, and this is what I do. I said, could you write us the white paper? And they did, and he did. And then we shared it with as many people as possible. It kind of got lost in the noise. I can't remember what happened the day it came out, but there was some other big noise that came out that kind of meant it didn't make the impact that it should have done. But yes, we did that, and the community's there. But subsequent to that, I've spent a lot of time speaking to asset allocators, corporate pension plans, fund managers of all types, and RAAs, registered investment advisors, about this. So it is on their radar screen. They're just slow to move. Now, that piece, I kind of said to individuals, you can do this too. And you were one of the people who did that. You just retired and you thought, well, okay, do I have enough savings to live off for the rest of my life? Probably not. What do I do? And I said, listen, this might be the answer. And I think hopefully some people have started to realize now that it is an answer, and it's a very meaningful answer. And it not only is it an asset class with hope, it's an asset class with upside, big upside, potential upside, 100x from here. So it doesn't really matter how early or late you are. And it fits into traditional portfolio asset allocation models. That means it's not a stupid investment for those pension plans and others. So I think it just over time, if we look at the adoption of the Bitcoin network and crypto network overall, the internet was growing at 63% a year from 1990 to 2000. Right now, and that in 1997, the internet had 140 million users, which is exactly where we are with crypto right now. Crypto is currently growing at 113%. So the internet was the fastest adoption of any technology in all recorded human history. Right. Crypto is twice the speed of adoption of the fastest ever recorded technology in all human history. We get to 1 billion people by 2024. That's exponentiality, my friend. We can't get our heads around how does 140 equal that, but that's what it does.
Excellent. So if one were to extrapolate what you're saying, we could literally be seeing every facet on the planet in this asset space in one way or another in the next 3 years. Pension plans, even the most conservative insurance entities, even the most stringent conservative endowment funds saying there's some there.
I think whether that's I think by 3 years we'll have broken the back of it, meaning the tide will have moved. Now we've seen the early adopters, that's clear. We're all celebrating those victories, but then it's just going to become regular that we hear this. So we'll have broken the back of the momentum. And by about 5 years, 6 years, it'll be expected, and you'll have to be answering to your trustees or your board why you've not used crypto. So that whole narrative will change because the regulators will have approved it. The central bank digital currencies will be in place. Crypto as an asset class will probably be worth 20 trillion, 30 trillion, whatever the number is, right? Then you've got no answer. The regulators have said, yes, here's your restrictions and how you can use it. And therefore people have to. So I've always said it's like being short a call option, i.e. the more it goes up, the more you have to buy it. So first, when you've got a collateral that moves a lot in value, it means you can lend less against it. It's as simple as that.
Oh, so it's just a skew. It's basically a ratio game.
So the lower volatility Bitcoin has over time as it gets more adopted, the more leverage there'll be against it. So right now, you hear these terms like things are over collateralized. It's because Bitcoin's very volatile. It's just been down 50% and gone back up another 30%, and we all kind of understand that of the space now. But so therefore, as a lender, well, if you'd have lent double on that, you'd have been wiped out. So it depends what kind of lender you are. Now, they get around it in this 100x or 25x and all of this extra by having automatic liquidations and stuff like that. So that's different. But really, for it to be the pristine collateral that it is, volatility, the more the volatility comes down over time as it gets more adopted, the more it can be used as collateral and the more value as collateral it has. And what is valuable collateral? Valuable collateral is collateral you can borrow against. Let's say 10-year bonds are 5% volatility for easy maths, and Bitcoin's 50%. It's not quite that, but roughly, right? That means with $1 of 10-year bonds, you can borrow 10 times against it. 10 times what you could in Bitcoin. Because Bitcoin's 10 times more volatile.